coming off the back of the biggest one-day drop on the S&P of the month so far, heading towards the first two-week loss of the S&P 500 of 2023. Equity futures going into the opening bow, taking some more weight off the S&P. We're down 0.6% on futures here. On the Nasdaq, down 0.75%. TEG running into some trouble in the bond market. There's the opening bow. Switch at the board and get to bonds. We look a little something like this on a 10-year. Yields higher by 2 or 3 basis points, 388. We were through 390 a little bit earlier on this morning. On a 2-year, we were through 470. We've backed away since then. On a 2-year right now, yields are still just a little bit higher by 3 basis points at 467. Dollar strength though making a comeback. Euro dollar negative 0.25%, 106.46, and crude softer, negative lower down here by almost 4%, $75 and about 50 cents. We're about 20 seconds into the session. We're down 0.5% on the S&P. On the Nasdaq, we're down 0.7. One stock to watch at the open, DraftKings, raising its full-year outlook with the CEO saying this: moving into 23, we'll continue to drive revenue growth and focus on expense management to accelerate our growth. That stock is up by 14%. Abby, it's flying.
It is flying, John. In fact, it's the best day of the year, the best day since November 10th of last year, and a big quarter, so it seems to be justified. This is a part of this travel and leisure rally that we're seeing this year into today. This stock up 56%. The quarter that they just posted, absolutely fabulous. They beat revenues, but they not only beat, it was 81% growth. They're focused on cost cutting, so that also helped them post a narrower loss than expected. Very importantly, they raised the view. Now, business is booming. It has a lot to do with the fact that there is a lot of legal gambling going on out there. 33 states, it's now legal to gamble, so that's really helping numbers move in the right direction. Fourth quarter revenues of $855 million, more than all of 2020. We're looking at big year-over-year growth with just more potential as more states could come online. We're looking at the possibility of this company putting up nearly $3 billion in revenue this year, more than $3.5 billion next year. As for the rally in this broad space, John, it's incredible, these year-to-date numbers. So at this point, look at that. DraftKings up 76% this year, really blowing away some of these other big movers such as Airbnb, Warner Brothers, and Wynn Resorts. Folks really spending big time on this travel and leisure space, John.
I don't gamble on sports, but Jamie in the control room does. And Jamie showed me this morning that he won $800 and he's going to buy everyone breakfast after the show. So everyone in the control room, on the floor, if you're aware of that, that's happening. Abby, thank you. Jamie's going to love that. Another guidance meet from Deere. Deere, a beat and a raise. Higher crop prices keeping farmers' demand strong. The CEO, John May, saying this: Deere is looking forward to another strong year on the basis of positive fundamentals, low machine inventories, and a continuation of solid execution. Katie has more. Hey, Katie.
Hey, John. Well, like you said, grain prices are high, farmers are spending, and that is good news for Deere. A beat and raise quarter. Sales and profit both came in above forecast, and the tractor maker raised its guidance as well. The company now sees net income for fiscal 2023 coming in between $8.75 billion and $9.25 billion. That is well above the average analyst estimate of about $8.36 billion. And like I just said, Deere is selling more because farmers are making more. If you look at the farm gross income over the past 2 years or so, it's up more than 50%. Net income up a whopping 72% over that span. And all told, the value of U.S. farmland is up about 20% or so. So that translates into more tractors sold by Deere. That is the wealth effect in action, John. And you can see it in the share price. I think this next chart is really fascinating. If you look over the past 3 years or so, the S&P 500, it's up a pedestrian 20%. Deere is up almost 150% in that time. And this isn't on the chart, but just for context, Apple is up 87%. So Deere is really dominating.
Stock's flying again, up another 3%. Katie, thank you. That stock's dominating. The airlines year to date, I keep going back to this. So this is America. American Airlines is up 29% year to date. United up close to 30. Delta up by 16 or 17%. That's the story with those names. Look to Europe, you see the same thing. I'll do Air France year to date for you just quickly. Including today's move, up about 45%, 44.5%. Up today by another 6. It's not just them. It's Deutsche Lufthansa as well. That stock's up by 25. Finnair, don't know if you've ever traveled with Finnair, but that stock's up by about 50% year to date. Air France up 6% just in today's session after 4Q earnings, expecting a return to full passenger capacity and an exit from state aid in the coming months. The CEO said this: we close out the year with a positive net income, having turned the page on COVID. So many of the airlines getting a big bounce, and a lot of this stuff, luxury players, miners, the airlines, it's all taking place over in Europe as well. I want to pick up on that story because a lot of people are starting to look for opportunities outside of the United States. We've heard that a lot on this program over the last few months. Here's what RB's Richard Bernstein had to say.
The U.S. market is dominated by three sectors. It's dominated by tech, it's dominated by consumer discretionary, and dominated by communications. Those three sectors still make up about 45% of the U.S. market. And what we found in 2022 was that country performance was directly related to how little exposure the country had to those three sectors. There's plenty of opportunities, whether it's in Europe, whether it's in Japan, whether it's in China. The menu of opportunities is extraordinarily broad.
Barclays looking abroad as well. I keep hearing so much of this, you do too. This is what they have to say. With growth holding up better than feared, more sensible rate expectations priced in post the hawkish central bank talk, and positioning still not stretched, cautious optimism on EU international equities still feels right to us. Clear Harbour's Aaron Cannon joins us right now. Aaron, great to have you with us. It's been a while. We should catch up more often. Let's start with that story. International. Does that make sense to you still?
Yeah, I think, at the end of the day, diversification is that sort of last free lunch for all of us as investors. And, certainly Europe in particular, just taking off on the last remark made, Europe in particular has been under significant amount of pressure. And a lot of that was due to the idea that energy prices would remain extraordinarily lofty, really pushing industrial giants out of the economy and making them far less competitive than, let's say, those in the United States. That dynamic has surprised to the downside in terms of cost pressures. And so Europe's certainly more competitive, and that's been a bright spot year to date. I think a lot of investors have been caught off guard with that.
Well, it's helped send the FTSE to a record, Aaron. It's helped send the equity market in Paris to a record as well. But at the same time, something else has been taking place, which I think has taken the headlines away from that story, and it's been the dominance of tech. And if you afford me the time, I'll just go through some of the numbers. Before today's session, Meta up 43% year to date, Tesla up 64%, Apple up 18%. These are big moves. And what's interesting about the moves in tech, Aaron, I get a lot of people coming on and say, I question that. It doesn't make sense. Look at what's happening in rates. So show them what happens in Europe, and they can justify it. And what I'm trying to figure out, Aaron, is can you get a correction in US tech and still get that performance in the European story that people seem to have more faith in?
Yeah, I certainly think the answer to that is yes. I mean, at the end of the day, I think, looking further out, we have to think about the interplay of equities and the equity risk premium with the fixed income market. And if one argues that we're going to have a more hawkish ECB and a more hawkish Fed, as we have just over the last few days, I think now priced into the market, I think those are both ultimately, at least near to medium term headwinds for the equity landscape. And I'm not sure that's priced in, not to mention the idea that earnings are flat and are certainly not even pricing in a modest recession yet. And so if we were to do that, right now, if you look at the U.S. equity market, John, we're trading at almost 19 times forward earnings multiples, and we have rates having gone from 1.5% in the 2-year Treasury part of the curve to 4.67 here this morning. That would suggest to me that equities need to adjust. Technicals remain strong, but fundamentals are really not all that attractive at the moment, both in tech and really across the board. Certainly there are opportunities when you lift up the hood, but the overall market is not particularly attractive, both in Europe and here in the U.S.
You've said to me before that the peak in Fed funds rate should coincide with the peak in the 2-year. Based on how well priced the 2-year is right now, are we getting closer to that point?
Well, it seems as though we are, but as we approach the peak, it seems like the Fed funds futures market is pricing in another rate hike. And so we now need to wait until about mid-2024 to see a rate cut. And will 2-year treasuries approach 5% is almost the implication of your question. And I think there's certainly a chance that if it looks like there's a 25-25-50 or 50-25-25 priced in, we could certainly see the 2-year move higher here. But if you look at long-term inflation expectations at 235, 240, and you look at the 2-year part of the curve, 2-year treasuries look reasonably attractive.
It's not just the Fed, though. It's the ECB as well. We mentioned that on the program a little bit earlier. The ECB's Isabel Schnabel was speaking a little bit earlier this morning, Gary, and she said risks are that this market is underestimating inflation. Now, that's the Fed, that's the ECB. And I guess the real unknown is whether the BOJ joins in. Do you expect they will?
It's going to be really interesting, John. I think that we may be in the midst of a tectonic shift in how we think about the Japanese interest rate regime, how we think about disinflation versus reflation. They've been fighting it for 20 years. We have a new regime coming in, and we have inflation in the world and a bit of inflation in Japan. And even if the Bank of Japan moves off the 0 to 50 basis point bound, which I suspect there's a rising likelihood that that's going to happen, there could be a rather significant capital shift. Mr. and Mrs. Watanabe, the savers in Japan, have been doing the carry trade, have been taking their Japanese yen, have been reinvesting them overseas for the last 20 years in higher yielding fixed income and to some extent equities. And to the extent that it now appears as though maybe the Japanese Bank of Japan moves off that 0 to 50 basis point bound, you could see a lot of reshoring of capital. It has huge consequences for the yen. I think it increases the likelihood of a stronger yen going forward. And it has huge repercussions, of course, for demand for fixed income here in dollar-denominated assets, in euro, and Brazil. Everywhere Mr. and Mrs. Watanabe was buying over the last 20 years, you could start to see a bit of a fading of demand on that front. And I think we need to be thinking about that as investors.
Where do you think is most vulnerable? You mentioned the US, you mentioned Europe, specifically fixed income there. We know that story. You mentioned Brazil as well. Where do you think is most vulnerable?
Well, I mean, there are a lot of moving parts there, but undoubtedly, the Japanese capital allocation has been heavy in U.S. dollars, has been heavy in euros as well, and to some extent Australia and New Zealand, on the margin in Latin America and places like South America and Brazil. And so, I think it's all on the margin. Certainly U.S. dollars are a function of that. Now, will 10-year treasuries trade higher in yield because, maybe 6 months from now we see the Bank of Japan shift policy? Could that be a catalyst? I'm not sure if the force will be that strong, but I think the most significant point here is the likelihood of a stronger yen going forward.
When do you start to think about maybe sovereigns struggling with some of this? The argument going into this rate hiking cycle was that the Fed couldn't go only so far, because once they got to a certain level, it would be problematic because we have so much debt, particularly with the sovereign, and they'd have to back away. And then here we are talking about 550, maybe going even further, and the ECB joining in and going 375, maybe pushing 4. When do you start to think about sovereign debt issues in DM, not EM, in DM?
An analogy, when you ask this question, I remember during the COVID crisis when oil traded negative. We sat around here in the office and said, well, we don't think oil is going to trade at negative to 0 for a long time. But if it trades at extraordinarily low levels, well below lifting costs of oil companies, how long can they stay in business? And you're asking the same question, but at the government level. And I think that's the challenge of the moment. And I think central banks are fully aware of that. Every 1.5% rise in the weighted average cost of capital of the U.S. government adds $450 billion U.S. dollars to our interest payments. I mean, that funds almost more than half of our U.S. defense budget. And so this is a huge challenge. I think the Fed is fully aware of it. The Treasury is fully aware of it. And that's another reason why we need to fight off inflation sooner rather than later, because time is of the essence in some sense in moving back down to the 2% bound.
Or do you think ultimately, as Mohammed alluded and suggested, that we just have to accept a higher inflation rate?
Well, I know I did see him earlier on your show. We'll have to see. That's not going to happen overnight. I think the central bank's going to fight that from a communication perspective quite hard. And frankly, there are, as Mohammed even alluded to, there are initial and rather significant disinflationary trends currently in the market. So I know the narrative of the last week or two is inflation is here, it's going to be sticky, the Fed's going to raise rates. But if you look at M2 money supply, gosh, it's now negative on an annualized basis, and we haven't seen that since the Great Depression. You look at certain aspects of the economy, wages are decelerating on the margin. You look at core CPI and you sort of remove the shelter component, and it really was only up fractionally, I think like 0.2% month over month in January. So there are trends, but certainly the challenge is, not to sound like a broken record, employment remains strong, retail sales and consumption remains relatively strong, and that consumer is still chasing goods in a way that's keeping inflation perhaps more lofty for longer.
Yeah, big time. That's the story of the week, story of the year so far. Aaron Cannon. Aaron, thank you, sir. As always, it's good to catch up. About 15 minutes into the session, we're down 0.75% on the S&P, on the Nasdaq down almost 1 full percentage point. Coming up from Wall Street to Silicon Valley, the job cuts keep piling up.
We have been seeing earnings estimates coming down already. You've seen the margins compress. You've seen layoffs being announced.
That conversation still ahead.
You've seen layoffs being announced. We have been seeing earnings estimates coming down already. You've seen the margins compress. This market feels like a patient that has taken the medicine, but the medicine hasn't fully developed its impact yet.
You don't see it in jobless claims, but you hear it from big companies. Job cuts. Bank of America, the latest firm on Wall Street to cut back, announcing plans to reduce headcount within the investment bank. In the tech space, weakening PC demand forcing Lenovo to warn about upcoming layoffs, and even Apple beginning to cut ties with contractors. This according to the New York Post. Team coverage begins right now with Sonali Basak here in New York, Ed Ludlow on the West Coast. Ed, first to you. Walk me through that Apple story.
Yeah, it's important. You know, we've written a lot at Bloomberg and done the data analysis on how Apple hired more prudently, judiciously over the pandemic period and boosted its revenue per employee, and so therefore has been the only mega cap so far not to do layoffs. What the New York Post is saying, citing unnamed sources, is that they have a large body of contract workers in the thousands, though Apple's never disclosed it, that they are now starting to cancel contracts early. Many of these contractors are hired on a 12 to 15-month basis, and according to this New York Post report, they're actively cancelling those contracts, as well as some of the sort of vendor agreements they have with third parties for events and such. That chart is what I'm talking about, right? That's on the screen right now. Look at how Apple hired or grew headcount over the pandemic period, and it tells the story of why they have not done mass layoffs so far. I've asked Apple, I've written to them this morning and said, can we talk about this? You know, what is the truth of this? What's going on here? Because they have not made that kind of specific action. Very quickly on Lenovo, John, this is a company that had 82,000 employees as of the end of the September quarter. That's the latest data we have. The CEO of Lenovo, the world's biggest PC maker, did not say how many they would cut, but it would be a small proportion of overall OPEX reductions that they're targeting. So an ongoing theme on the Lenovo side because of the slowdown in the end user market.
So that's tech. Sonali, I think Ed's right to frame it that way. It's about overhiring excess through the pandemic. What is it in the financial world?
It's certainly true, John, that you saw banks hire significantly, do acquisitions, and hire a lot of people to meet the demand of a lot of business during that time frame. But think about Bank of America alone. When you look at December, Brian Moynihan said he was not looking to cut jobs in the investment bank. They were slowing hiring. What they were trying to do is pull every lever they could. They moved investment bankers to different parts of the business, but now that they're starting to cut jobs, you and I started at the beginning of this week talking about Goldman Sachs wishing that they started this exercise earlier. In a couple of months from now, will Bank of America be doing the same thing? Is this a signal of having too many bodies to meet the current macro environment, or is this a signal that they believe things will continue to get worse because they can't keep these 200-some people on staff? It's a question of whether this will get much worse from here. Remember, 200 people at Bank of America. It's not a lot in the grand scheme of things, but again, remembering that they had spent months and months and months trying not to do this has been a big thing when you look at now a crack starting to crack even more in the Wall Street hiring market.
Hey, Sonali, thank you. Appreciate it. I know you're going to stay on top of that story. And to you, Ed, the no-tie thing on the West Coast is totally fine. That works. It's all right. Looks good, buddy. Looking forward to the show later.
Friday.
Ed Ludlow, to you as well. Sonali Basak, thank you. The latest comments from the Fed. Governor Michelle Bowman speaking right now, saying that inflation is still too high, not seeing what they want to see in the inflation data. This is no surprise to you. Need to continue hiking rates until we see more progress. This coming off the back of the remarks, of course, yesterday from Loretta Mester, who's a non-voter, coming out and saying she saw compelling reasons to go 50 at the last meeting. And Jim Bullard of the St. Louis Fed, also a non-voter, saying almost exactly the same thing. The governor of the Fed, of course, has a vote. So Michelle Bowman, worth looking out for those headlines as they come through in the next couple of minutes. Want to get you some sector price action? We've got time for that. Here's Abby.
And it's unclear, John, whether or not those headlines are influencing the S&P 500, but it is trading at session lows, perhaps on the idea that the Fed is going to be raising and hiking longer than expected. Sector-wise, most sectors are lower. Energy the worst, down 3% as oil falls for a fourth day in a row. And we're looking at 2 weeks of losses for the S&P 500 overall, the first time, John, that we've seen that this year. But we've got some winners and losers to the upside. Autos and tech on the downside. Energy, interestingly, is down 6.4%.
Abby, thank you. Appreciate it. Your trading diary up next. 25 minutes in, we're down for a second day on the S&P. We're down for a second week, potentially, if we close this way. We're down about 1% on the S&P, on the NASDAQ, down by 1.4, taking a bite out of the year-to-date gains on that index, and it's been pretty punchy stuff. That's the move in the equity market. Let's get you the trading diary. Coming up, U.S. markets closed on Monday for President's Day. Long weekend here stateside. Earnings from Home Depot, Walmart before the open and bow Tuesday. FOMC minutes could be very interesting on Wednesday. Look out for that. Fed President Bostic daily speaking on Thursday, plus U.S. GDP, core PCE, and another round of jobless claims as we go towards the weekend. Looking forward to that. From New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. And if you are stateside, enjoy the long weekend. That does it for me. This was the Countdown to the Open. This is Bloomberg TV.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, February 17th. Here are the top market stories we're following for you at this hour. King Dollar is back. Dollar erasing losses for the year as hawks keep flying in Europe and the U.S. We're going to get the trade. And no landing equals hard landing. So Bank of America says the stronger U.S. is now, the harder the recession will hit in the future. Stocks take a dive. The NASDAQ 100 up over 1%. And flying into an uncertain economy. We're going to sit down for an exclusive interview with JetBlue's CEO Robin Hayes to get his take from the skies. From New York, I'm Alex Steele with my co-host in London, Stephen Carroll. I was going to say Guy Johnson, but you're not Guy Johnson because he's still skiing in Italy. You're Stephen Carroll. Welcome to Bloomberg Markets. Stephen, you are a radio guru. It's your first time on Bloomberg Television with me anchoring. Welcome. Thanks for joining me.
Thanks very much. I think the radio expression would be long-time listener, first-time caller. So I'm very happy to be here with you on the show. I'm no Guy Johnson, but we'll do our best. We've got lots coming up on the show to look forward to.
Indeed. It was great to have you. I mean, you can be Guy. He's just super tall. I think that's the only distinction. So it's a really interesting day to have you as well. We are having a pretty heavy equity market, dollar rising, yields a bit higher. It all comes down, though, to central banks and kind of where the hawks are going to fly, how hard they're going to fly, whether you're in the ECB or the Fed.
Yeah, absolutely. I mean, look at our interview with Isabel Schnabel from the ECB today, really giving us an idea of the hawkish signals that are coming at least from that quarter of the European Central Bank as well, telling us that, you know, that there's still a lot further to go when it comes to rate hikes and getting inflation under control, and signaling very clearly that there are people on that council that want to go much higher.
And then once you add in the options market, things get a little bit complicated. So let's get to it. Our question of the day for this hour is King Dollar again? I thought we were moving away from that, but maybe we're back to that. I'm not really sure. Joining us to help discuss is Bloomberg's Kriti Gupta and Ed Harrison. Guys, thanks so much. It's great to have you both with us. Kriti, let's start with you. The idea was weaker dollar this year. I get that we've seen a rebound, but is this King Dollar? Are we back to this?
We might be back to this, and I think it's important to look at the market reaction here because I think we've pared back a good chunk of that kind of leg lower that we took. Now, I'm going to give you the bull case and the bear case here. I'm going to start with the bull case. It's pretty simple. Evan Brown put it beautifully over at UBS. Basically, we might be in a phase of mini reflation, this idea that you're starting to see inflation perhaps not decelerate at the margin that we were expecting and potentially even tick up higher. Remember, this is something we're seeing in other parts of the world, Spain, Brazil, where inflation is ticking back higher. Factor in now higher commodity prices, which may come down the road. And yes, the trade is easy. Higher inflation, more hawkish Federal Reserve equals King Dollar. That being said, the bear case here is what's going on across the Atlantic. The European story is crucial because right now, as things stand, if you're still looking at a 25 basis point hike from the Federal Reserve, the ECB is still the most hawkish bank around the world right now. And that's significant because it creates these interest rate differentials in favor of the euro that then creates a weakening case for the dollar. And if you actually look at the decline in the dollar, the weakness in the dollar year to date, a lot of that has come from simply euro strength. Mm-hmm.
Hey, Ed, it's great to have you. I'm interested in how you feel about, you know, the commentary we've got at Schnabel. She's very, very hawkish. She's, you know, indicating there's much further to go when it comes to the ECB. Is we going to see a return to euro strength to compete with the dollar?
Yeah, I think that the euro is going to be, King Dollar is not going to be as king as it was before because other currencies are going to take its place. I think we can look at the yen, but we can also look at the euro. The U.S. was the first into the hiking cycle, this 50 basis points, 75 basis point rate hikes. They're also going to be the first to go down. So that means that, yes, we're going to get some more 25 basis point hikes from the Fed. We'll get 2, maybe 3, but they're going to stop. They're not going to go to 6% except under the most dire circumstances. And so they're going to be stopping when other central banks are going to be continuing on. The one currency that is probably more dovish than the U.S. dollar in that scenario is the pound. So I think that, King Dollar, there's been somewhat of a retracement here, but we're about as high as we're going to get. If you look at DXY, at 104 handle.
Yeah.
We were as high as 114, 115 before.
Hey, Ed, what happens if the economy continues to hold up in the U.S.? Does that change the narrative? Or flip side, what happens if growth elsewhere kind of falls out of bed? Then it feels like the dollar is a safe haven and then also a recovery play at the same time. It's like both sides of the smile kick back up.
Right. Yeah. I mean, I think that the problem for the dollar at this point is the fact that the Fed has already hiked rates by 500 basis points, or they will have hiked rates by 500 basis points. The whole concept that, the cumulative tightening, I think that's still very much at play, that even if the economy continues to run hot, they're not going to go up to 6.5% in all likelihood. There are too many doves on the FOMC who want to pause, get to that plateau level, and just see how things pan out. So I think we're really close to the end of the cycle, and therefore, just from a relative perspective, even if in other places things fall apart, the dollar is almost at its apogee in terms of what's possible. We're just playing catch up now this year to what the Fed has said. The bond market is catching up to what the Fed dot plot has said. We're pretty much there, and I don't think that we're going to go that much further in 2023.
Critty, give us an idea of what you think could knock the dollar off this perch. What's the data point? What's the metric that you think that could be what changes the game here?
I'm going to be kind of boring here. Maybe there isn't a fundamental narrative. Cameron Kreis, one of the first things he told me is sometimes traders trade because they want to trade. I think positioning is a more important story here, because if you look at the market and the FX story right now, even with the decline and the weakness you've seen in the last, I want to say 4 or 5 months in the dollar, and even the retracement that you've seen, as Ed pointed out, year to date, you are still seeing the market long dollar. So I think that is going to be kind of one of the major factors, that even if there is, say, weaker growth around the world, if it's still seen as a safe haven, people are already positioned for that. And I think it's really hard to let that go, given that they've been positioned long dollar for several years now. It's really hard to unwind that trade.
So here's the thing. We're seeing markets reprice the ECB and the Fed. Terminal rate now 5.3%. Even the ECB, maybe we could even see 3.75%. We'll talk about that in the next hour as well. If the whole market has to re-rate higher from that perspective, where's the biggest shakeout?
Well, it's already kind of happening, right? Because even
is it though? I mean, I'm just looking at tech. Okay, we're down 1%, but that's Apple and Microsoft.
It is Apple and Microsoft, but let's start with the FX market here, because you are seeing the dollar. I'm looking at the Bloomberg Dollar Index higher, about 0.3%, weakness in the euro. That has actually kind of been the story. Not massive growth or massive moves, but the bid into the dollar this week has really come off the Fed swaps repricing. The idea that a terminal rate could hit 5.5%, big emphasis on could, and potentially even 6% if you're one of those people who are betting on that in the options market. The tech side of the story, though, is important, because the bond market and the stock market are diverging here. They are no longer tied to the hip that they were. And if you actually look, I'm going to get nerdy here, bear with me, you love it, Alex,
I do.
Is if you actually look at the more intraday correlations, the 1-month correlation, the breakdown is far more severe. Look at it on a 3-month basis, it still looks like yields hit tech. Look at it year to date, and that's not necessarily the case. It brings to the question how much of the carnage of 2022 was priced in, and fundamentally, this makes sense, because 2022, the narrative was, we're going to hit a hard landing, the Fed doesn't know what it's doing, and in the last few weeks, the idea of a no landing, a soft landing, has entered the fray, and I think that is what's changing the equity market more so than the bond market.
Ed, how does the no landing scenario feed into the higher for longer narrative of the Fed?
Yeah, I think that the no landing scenario is problematic for the Fed, because if you look at the unemployment rate as an example, 3.4%, a lot of people have made hay about the fact that it's a 54-year low, but actually it's the plateau low for the 1960s. You have to go back to 1953 to see a unemployment level rate that's lower than that. So the concept that we could be chugging along, with no landing at 3.3% unemployment, the 50-year low, 70-year low, doesn't really, it's problematic for the Fed in terms of their reaction function. So that doesn't necessarily mean that they're going to get off the plateau once they reach the terminal rate, but it does mean that and if inflation doesn't come down, the next rate hike is going to be higher. The next rate move is going to be a rate hike, say in 2024. So I think that it's baked in the cake that the Fed will get to a certain level of plateau, and they'll remain there for a while. They'll reassess the position, and then if the no landing scenario is in play, they're going to have to go higher in 2024, which is not what's priced into the market.
Okay, thank you to you both. Bloomberg's Ed Harrison and Critty Gupta as well. Thank you to you both. Coming up next, more on our question of the day, King Dollar. Again, we're going to ask Steve Sosnick, Interactive Brokers Chief Strategist. Stay with us for that. This is Bloomberg.
Boom season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The Bulls have had the year-to-date run. I think it's going to be a year where we frustrate both the Bulls and the Bears. Now it's time for the Bulls to be frustrated.
That was Bob Dahl, Crossmark Global Investment CIO, earlier on Bloomberg TV. Want to get to the question of the day, King Dollar again? I feel like we've seen this movie play out before. Joining us now, Steve Sosnick, Interactive Brokers Chief Strategist. Steve, King Dollar, you think?
I still think it is King Dollar. I mean, right now,
really?
Yeah. I mean, okay. I mean, do we go back to the highs? Not necessarily. But I think do we test, let's say, the 200-day moving average on DXY, which is the 106 area? I don't see why not. We're talking about raising rates more aggressively than many of these other competitor currencies, for lack of a better word. Maybe the Bank of Japan gets off the schneid. Maybe the ECB gets moving. Maybe But bottom line is we're high already relative to these other currencies and going higher. So I don't see the big drag on the dollar. Let's put it that way.
So consensus was, like a week ago, that we could see a little bit of dollar weakness now, but then dollar strength towards the end of the year. If we get the dollar strength now and it continues, what does it do to other asset classes? Like, what kind of positions and options are going to have to be shaken out from that?
Well, anytime you have a break of consensus, whether it's the dollar, whether it's interest rates, et cetera, things break. And I think that's kind of what we've been seeing over the last couple of days. Was we had this big consensus that we were going to soft land, not land, whatever we want to do it. And now all of a sudden it's like, oh wait, here's the consequences, and that is, we're talking about interest rate hikes for higher and longer.
What about sectors when it comes to a strong dollar, though? Are there certain sectors you're going to be worried about that if we continue to see this return of King Dollar, that you're going to end up, having to make some tough decisions?
Oh, absolutely. The problem is, a stronger dollar is not good for U.S. multinationals that export. It's definitely a drag, on emerging markets in some respects because their costs go up, especially if they're borrowing in dollars. And so it's not a great sign. But the problem is when you start to talk about currencies, it's all relative, and they can't all be lower or they can't all be higher at the same time relative to each other. Someone's got to be winning, somebody's got to be losing, and I think what the Fed is saying is we don't really care if we push the dollar higher because we've got our work to do.
Yeah, and talking about sectors like energy getting hit really hard as oil falls out of bed, and you could blame that on the dollar in some capacity. Okay, let's get to the fun stuff, options. So today's options expirations, and usually we bring you on and be like, oh my God, how many options are expiring? What's the volatility? Yeah. But that's not the story today. There's not even that many options because it feels like every day now it's options expiring.
Well, it is actually quite literally when once we've started to add the what they call the zero-dated options. Every day there's something expiring. Now, one thing to put in perspective on an options expiration day like today, every options class has zero-dated options, right? Because that means they're literally expiring. But there's been a lot of hue and cry about these, the zero-dated options. I look at them as not a new product, but more or less that the existing casinos just added a lot more tables, and so you're bringing in a lot more potential, and I call them gamblers because it is a lot of speculation. We've made it very easy for options to be used as a speculative tool. From an industry, we like it because the volumes are enormous. But anytime you do something different, it creates some issues. And I think we're having to adjust to the idea that we've facilitated another round of speculation.
Wait, so does the market react to that then? Are we looking for volatility on these options expiry days from here on, or is this something that we're going to have to see more volatility around these dates as a result?
Well, I think over time we've sort of figured out what to do with monthly and quarterly expirations. If you remember, the triple witching expirations were, everybody would be panicking coming into them. What's going to happen? We've learned to deal with them over time, and especially as weekly options came in, and now you've got daily options in a whole bunch of classes. We're going to figure that out too. But right now, what's happened was once we started to get some positive momentum, people speculative juices came flying back, and this became the latest tool that a lot of speculators have gravitated towards.
So in that sense, when we look at equity moves now, is there any signal that we can actually get from it? Or is it all just delta and gamma? So options needing to cover and dealers needing to take the opposite trade?
There is a lot of noise, and that's, I guess, and we've seen what I would call microbursts of volatility, where we've just had some days that we've just exploded, and it's not really clear why. I think of the Thursday between the FOMC meeting and the payrolls numbers, when the options industry set a record in terms of volume. There wasn't much to it, but the speculation comes. And I'm seeing it now, the playbook. Just before I came on air, I'm looking at spiders, which is probably the easiest one to speculate with in many ways. And people were already buying, the next highest strike or two on calls. Those volumes were already over 70,000, and it was, it was 10 in the morning. Wow. So people, that's one of the tools that people have been using to sort of facilitate the gamma squeeze. But over time, again, people will figure it out. And also, these are the most expensive options to buy. They're low priced, but they expire at the end of the day. So you're buying pure decay. So this is how the industry will figure it out. But over time, it's tough to deal. It's sort of the pig and the boa constrictor. You've got this huge flow of volume coming through in a relatively new place.
When they do figure it out, and we have some sort of a resolution on that, what do we get back to? Where are the fundamentals you're pointing to right now in this market? Is this earnings?
I think right now we've morphed from momentum to earnings, and now back to momentum. I think a lot of the rally that we've seen year to date was January effect. December was terrible, and most of the stocks that started to lead the rally in January were among the stocks that had gotten clobbered in 2022. There were a lot of tax losses to be taken in Meta, in Amazon, in Tesla, et cetera. Guess what's leading in 2023? It's some of those same stocks. But again, once you get momentum, it does strange things. And so I think we started to overlook a lot of the fundamentals. I think we were very charitable in earnings season, which was good. But I think now we have to do a little distinguishing between companies that beat a depressed earnings estimate versus those that have real sustainable earnings power and the cash flows with which they can return money to shareholders.
Steve, I really appreciate it. And, case in point, the Dow's now flat. So you just can't necessarily trust these moves. Hey, Steve, really appreciate it. Happy weekend. Steve Sosnick of Interactive Brokers. All right, still ahead, a report saying that Apple's set to cut ties with hundreds of contractors. We're going to get the latest in the job cuts in tech next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. One of the biggest car dealership chains in the U.S. expects prices for new and used cars to fall this year. Still, AutoNation doesn't expect sales to return to pre-pandemic levels in 2023. The company reported higher than expected earnings in the fourth quarter, but gross profit on new cars fell 13% from a year ago. Deere has raised its earnings guidance above analyst estimates. Higher crop prices keep farmers spending, and that's led to a record windfall for the biggest maker of farm machinery. A year ago, Russia's invasion of Ukraine sent wheat futures to a record. Deere is betting that crops will stay pricey, enabling farmers to replace aging fleets of tractors and harvesters. And a bidding war could be brewing for Manchester United. Bloomberg has learned that Qatari investors, including the country's former Prime Minister and ex-head of the Qatar Investment Authority, are preparing a roughly $6 billion opening bid to acquire the English football giant from the US Glazer family. Meanwhile, British billionaire Jim Ratcliffe has already lined up financing. And that is your latest Business Flash, Alex.
All right, Ritika, thank you very much. It is 23 minutes past 7 on the West Coast. Want to get to the startup? That looks like a promising day. We're going to cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-anchor Ed Ludlow. Ed, it's a pretty sunrise, but are we looking at job cuts in the industry, and that doesn't feel very good for a Friday morning?
Yeah, it was a surprising headline, the New York Post reporting that Apple has started cutting contractors. Now, Apple has never disclosed how many contractors it has, but it's in the thousands. And what the New York Post article is saying, citing unnamed sources, is that, these are contractors that are on 12 to 15-month contracts, and rather than waiting them out, Apple is proactively cutting ties. And the reason it's surprising is that Bloomberg did all that data analysis just a week ago, right? That if you stack up the hiring that all of the mega cap tech companies did throughout the pandemic era, actually Apple was incredibly judicious and conservative. It did not have any bloat from the pandemic period, as that chart on the screen tells you. They also really dramatically boosted their revenue per employee. So this headline's a surprise. I've reached out to Apple. Apple are not commenting on the story either to the New York Post or to us. We'll have to see kind of what's going on here in terms of their financial health.
What about the other cuts we're hearing about and sort of the broader picture that we're getting from Lenovo, for example, a big player in PC makers?
Yeah, Lenovo is much more in line with what we've heard throughout earnings season globally, right? It's the biggest maker of laptops or PCs. And as of the end of the September quarter, because that's the latest data we have from the filings, they had around 82,000 employees. Basically, there's a slowdown in the end market. People are buying fewer laptops, so they're really dramatically targeting operating expenses. We didn't get a number in terms of the layoffs that Lenovo plans to do, but the CEO basically said, actually, headcount reduction is going to be a pretty small proportion of the cost savings that they target. That chart's so interesting, guys. I mean, we can debate it till the cows come home, but it's based on the Challenger Gray and Christmas data, and it's job cuts that have been announced in this industry. And if Mike McKee were here, Bloomberg economics correspondent, he'd hit me over the head and tell me to shut up and say, that's really interesting data because there's been a dramatic kind of uptick in the layoffs announced, right, to start this year on the right-hand side of your screen. But he'd also say, then go look at the jobless claims number. Totally. And it seems like lots of these are finding new jobs pretty quick, especially here out in Silicon Valley.
Totally, but that's why I think the Apple story is quite interesting, because the other you can say, okay, it's the bloat, but it feels like with Apple, is that an underlying demand thing? And that's where I think the distinction is.
Well, exactly, and that's why talking about Apple and Lenovo in the same conversation is worth it, right? Apple, in terms of disclosed employees, has a footprint of 164,000. So if it is cutting contractors, and those contractors are in the thousands, and again, Apple is not commenting on this story, but the stock's down a percentage point in line with market. Is this them reacting to that slowdown in demand? Yeah. Again, we just had earnings and the outlook was mixed, going forward for this year.
Yeah, but to that point, I am looking at Apple and Microsoft are the two biggest losers on the NASDAQ. They're erasing the most points for the NASDAQ. Exactly. So it's clearly having that impact. Ed, thanks very much. I also like the no-tie look, by the way. It's very San Francisco. Ed Ludlow joining us there. All right, coming up, we're going to take a look now at the U.S. efforts to ease some tensions with China. It's going to be front and center this weekend at the Munich Security Conference. How is this going to go? Are we going to see Blinken sort of make inroads in that? We're going to break that down. This is Bloomberg. right, we're about an hour into U.S. trading session. We've definitely played this movie before. Stocks off their lows. The Dow actually fighting for positive territory. Abby's tracking moves for us. Abby?
Yeah, it's a bit of a whippy day, and it's interesting because this is a one-week board, but the S&P 500 right now down about 0.6%. That's the amount the S&P 500 is down on the day. So if somehow we pull out a bullish reversal, which did not happen yesterday, but it's happened many other days, we could actually be looking at a weekly gain. But right now, we're looking at 2 down weeks for the S&P 500. If it holds, it will be the first time that we've seen that in 2023. A similar deal for the Dow, which is down on the week. I don't know if the Dow was down last week, actually. Some live TV thinking right here. But the NASDAQ and the Russell 2000, some outperformance, especially for small cap, up 1.2%. Perhaps that's a more positive tell for large cap next week, since small cap is typically a tell, a growthier tell. And this, of course, right here, this is the pressure. 2-year yields rising, hitting above 470 at one point. This on the idea that the Fed is, in fact, going to be doing what they've been saying that they're going to do for quite some time, and that is hike rates. We're now looking at 25 basis points priced in for the month of March, May, June creeping up there. Of course, we had some Fed officials yesterday floating out the idea of 50 basis points. I don't think that the market is taking to that so far, but stocks are down on this, especially the energy patch stocks. We have oil down on the week in a big way right now, down 4 days in a row. Devon Energy, of course, there's rising CapEx costs, down nearly 17% on the week. Apache, EOG, and there is crude oil down 5% on the week. So a bit of a risk off here. Or on the other hand, you could take the idea that it's some inflation relief, oil being down. And then finally, speaking of being down, well, bonds are certainly down. This TLT bond ETF, it has seen its biggest outflows over the last 5 days on the second most going back through its history. I believe this is the most right here last September. So the bond volatility continues to be absolutely tremendous, and we're seeing that again in this TLT bond ETF.
Yeah, I mean, Abigail, we're also seeing it in the long end. We're now seeing a bid come in, which is quite impressive as well. You have Tom Barkin also talking from the Fed, saying that he favors a 25 basis point steps, but he's not yet ready to declare victory on inflation. So smaller hike, sure, but still very forceful when it comes to inflation. Okay, we have the Munich Security Conference kicking off today. Part of the backdrop is the tensions between the U.S. and China. So President Biden is now looking to speak with President Xi Jinping. It's a sign of U.S. efforts to end the dispute after a Chinese balloon was shot down by the U.S. earlier this month. Joining us now with more, Emily Wilkins of Bloomberg Government. Is this meet really going to happen?
I mean, Alex, Biden is certainly hoping that it will. And of course, we're keeping a very close eye on the Munich Security Conference to see if Secretary of State Antony Blinken does meet with the top Chinese diplomat Wang Yi on the sidelines of this conference. They're hopeful that such a meeting can take place, but at this point, it does remain to be seen. Biden really wants to clear the air right now. He wants to get back to sort of having that relationship with China where the tensions are low, where the two are communicating on things. Obviously, that was, forgive the pun, but blown off course by everything that happened with the balloon and the other objects. But now that we're at the point that we've learned that the 3 objects shot down last weekend were not a part of any sort of Chinese surveillance item, it kind of clears the way for this potential meeting to happen between Blinken and Wang Yi, and then could potentially open the door for Biden and Xi to have another conversation between the two of them.
Emily, we'll have a pun on a Friday, so we'll allow it. Let's talk about, though, the sanctions imposed by the Chinese on, the 2 big U.S. defense companies, Raytheon and Lockheed Martin. I mean, is that a significant escalation of tension?
It is something of an escalation of tensions. And after, actually before China put those sanctions on those 2 major U.S. companies, the U.S. had put a number of Chinese companies on an export ban list. And so you have seen some going back and forth, this rising of tensions that have come after the security balloon. You saw reports this morning that there was spottings of a potential balloon over a Chinese town that wound up shutting down an airport for a couple hours. And it's kind of a question now, is Biden going to be able to get this relationship back on track, or are we going to see the tensions that have played out with this balloon continue to escalate? Further complicating that, you have a number of U.S. lawmakers that are interested in making a trip to Taiwan, including a top Pentagon official. You've also heard Speaker Kevin McCarthy talk about a willingness to do so. And of course, we saw after Speaker Pelosi's trip last year that you saw a definite increase in tensions between the U.S. and China. So I think a lot remains to be seen with the relationship. There's certainly the desire on behalf of the Biden administration to have that communication, have that line of networking. But at the same point, there is a very strong bipartisan consensus in D.C. right now that the U.S. needs to be very aggressive in its stance against China. And it's one of the few areas that you actually see that agreement on both sides.
Yeah, so then how does this set up the backdrop for the Munich Security Conference? Obviously, we're looking at 1 year of the war in Ukraine. How is China going to be factoring into these types of conversations that President Biden and lawmakers are going to be having on the ground there?
It's an excellent question. I mean, you're going to see Vice President Kamala Harris also be going to the Munich Security Conference. We are expecting them to engage in conversations about Ukraine and what it's going to look like going forward. The big question, of course, right now in the U.S.-Ukraine relationship is the amount of funding that the U.S. has previously provided going to be able to continue now that Republicans have control of the House. The Republicans have said that they do want to continue to support Ukraine. The vast majority of them do want to do that, but they also want to make sure that there are different transparency measures in place, that they know where the money is going, and of course that kind of opens the door as a question, what is actually any sort of future funding going to look like? And of course this all comes as you mentioned, Biden is set to go to Poland next week to commemorate the 1 year anniversary for the start in Ukraine. Biden's message has always been unity. It's always been a call to his allies to stick together, to come together on Ukraine. It will be interesting to see if that message is received differently now that Biden has a divided government to work with rather than the Democrat-controlled government he had for the last 2 years.
Okay, Emily Wilkins of Bloomberg Government, thank you very much for taking us through all of those consequences of the Munich Security Conference. Coming up next on the programme, travel demand is picking up, but is it enough to counteract the headwinds for airlines? We'll have an exclusive interview with JetBlue's CEO Robin Hayes next. This is Bloomberg.
keeping you up to date with news from around the world. Here's the first word. I'm Ritika Gupta. The federal judge overseeing the fraud trial of FTX co-founder Sam Bankman-Fried is threatening to send him to jail. Judge Lewis Kaplan wants severe restrictions placed on Bankman-Fried's use of electronic devices and apps. There's concern over his use of encrypted messaging app Signal to contact FTX's U.S. general counsel, a potential witness in the case. American shoppers are using their credit cards more than ever before. According to the New York Fed, credit card balances hit a record high of almost $1 trillion in the fourth quarter. Delinquency rates are up too, especially for borrowers in their 20s. They are struggling more than other age groups when it comes to paying their credit card and car loan bills. How does a 16-hour flight to nowhere sound good? That's what happened to passengers who boarded a flight from Auckland to New York Thursday night. A power outage at New York's JFK airport threw operations into disarray, affecting at least 135 flights. An Air New Zealand flight made a U-turn about halfway into its nearly 9,000-mile journey. Terminal 1 at JFK will remain closed today whilst operators work to restore flight operations. Global News powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, Ritika, thank you very much. Let's talk more about that. I mean, a 16-hour flight to nowhere sounds pretty terrible. We are joined with an exclusive interview by JetBlue's CEO, Robin Hayes. Lots to get through. You have all the disruptions. We got consumers. We got merger with Spirit. It's so great to get your perspective. Guy's sad he's missing you.
Oh, no. Great to be here, though.
So let's talk about this 16-flight hour to nowhere.
Yeah.
And I use that as an example of Lufthansa also having issues, the FAA having issues. I mean, what's happening right now in the airline world on the ground?
Well, you know, I think that there were definite challenges that we saw last year as demand came back very quickly and airlines had staffed up. I mean, what I'd say at JetBlue, we've got more people now working for us than we had in 2019. You know, we're very focused on flying our schedule. You know, we've got a lot more reserve pilots, in-flight crew members around to make sure that we can complete those trips. We can't do anything about the weather, and weather is always going to cause a disruption, but we want to make sure that we can get people to where they want to go.
But one of the main issues is that, you know, a power cord's cut and all of a sudden planes can't take off from Terminal 1 in JFK. I mean, this is kind of crazy things. Just ask Southwest that has to like really upgrade all their systems. Is there anything that you can do on your end? Do you have to upgrade stuff? Do you have to upgrade systems?
Well, we've been going through a multi-upgrade system in our systems operations center the last few years. We've got a great team at work. You know, I think after the adjustments we had to make last August, we did a really good job during the summer getting people to where they wanted to go, largely because of some of those upgrades that we had made. So, look, I understand the frustration that exists. And it, you know, has been a very challenging year. But I mean, in the United States, about 20,000 flights happen every day, and the vast majority of those happen without any issue at all.
Fair. We just like to pick on the ones that don't, to be fair. But in general, can you give me some perspective? Like, does the government need to upgrade some systems here? Like, is the infrastructure really not adept and in tune with what your business actually does?
So, you know, I'm very proud the U.S. has a very safe industry. You know, the FAA has done a tremendous job. The airlines are very committed to that partnership. But there is an opportunity for the FAA to do two things. First of all, we have to get our controllers fully staffed. And that's important because the system's safe, but what will happen if there's a shortage of controllers, we'll just see more delays and cancellations. So we've got to get controllers fully staffed. And then the FAA has a multi-year technology upgrade program. We've got to get that finished. The airlines are equipped. You know, you get on a JetBlue airplane, we've got satellite communications, we've got datacom in the cockpits, everyone's trained to use it. But we need to get the FAA at the sort of further forward, if you like, with this technology upgrade.
Hey Robin, it's Stephen in London.
Hey Steve.
What's all this costing you then in terms of, you're talking about your own contingency plans but also being affected by disruption calls elsewhere. So what does that mean for your margins and for costs?
No, you know, it definitely has added cost. I mean, last year we had to hire a significant number of extra crew members to just make our schedule more robust, to make sure that we could fly people to where they wanted to go. And it does come at a cost. But you know, there are so many more constraints on the system now than there were in 2019, or all airlines have to do this. You know, we've all got more people than we had before. We're flying airplanes less hours per day than we were before, and we're doing that because we want to make sure in the US that the system is more robust. And so it does come at a cost, but you know, there's a much longer term cost if we can't fly people reliably to where they want to go.
Does that mean, though, for passengers that you're going to be talking about people having to pay more as well?
Well, you know, fares have gone up in many cases, but I would say the biggest factor on that is fuel. I mean, if I compare what we're paying for fuel compared to 2019, you know, we're seeing a very significant increase in cost, and it is the largest cost that any airline has. So, you know, I think as capacity comes back, hopefully as fuel starts to come down, you know, you'll see fares low. But I mean, I think that's one of the best things about JetBlue as well. You know, we are known for bringing lower fares, and we're going to continue to do that.
Good sales pitch.
Yes, thank you.
Yeah, good job. And also fuel costs in theory should be coming down. Just look at oil today, for example. Okay, let's get to Spirit Airlines. Any clarity on what the DOJ is going to do, if it's going to sue to stop the pending deal?
Well, we're working through the process with DOJ. We're still going through that now. I don't want to comment on that. I want to be respectful of the process.
But do you feel more optimistic that like scale of 1 to 10, 10 being everything sails through easy peasy, where are you feeling right now?
Well, I'm going to not give a score because I'm always wrong with numbers. But look, we agree with a lot of concerns the Department of Justice have expressed about airline competition. I've actually been making comments on this for years and years and years. We just believe the best thing that we can do to make a more competitive industry is to enable a bigger JetBlue. When JetBlue flies on the market, fares come down and service improves. We were the first airline to put live TV in the back of the seats. We've had free Wi-Fi for 10 years. We have the most legroom in coach. We don't overbook flights. And we offer low fares. No one else is doing all of that. And so with the merger with Spirit, we'll just better do that to a lot more places more quickly.
If you do manage to get the merger through, though, how are you going to avoid the problems that bigger operators have when it comes to, I mean, there's so many of them we can list, but there are so many issues about becoming a larger operator. How will you be able to keep that model as tight as you have it now?
Well, I think actually, you know, the biggest challenge that we have as JetBlue is just our concentration in the Northeast airspace, Stephen. I mean, if you look at last year, and nearly 2/3 of the total air traffic control delays happened in the JetBlue network. We operate in and out of the most congested airspace. By actually having a bigger, more national network, it will actually reduce the impact that we have in terms of some of these difficult geographies and delays. So we actually think it's going to make our operation much easier. Plus, Spirit and JetBlue, we fly the same airplanes, we have the same engines, so there's huge benefits operationally with a single fleet type.
Any conversation about divestitures and stuff with the DOJ? How's that going?
Well, again, the good news is we came up front straight away with the most significant divestiture offer of any merger in the US. You know, bear in mind when these large airlines merged before, they had to do nothing or very little. So, you know, we've offered that in the New York airports, Boston and Fort Lauderdale. And, you know, we think that that's going to enable both new entrants to come into the market in a way that they would not be able to do today, and it's going to enable a bigger JetBlue.
Let's talk about something Airbus said earlier this week. They are reducing the number of planned JetBlue deliveries this year. You had mentioned 22 in January. That's probably going to be lower. Does that, and it's really a supply chain issue backup, does that slow any kind of expansion plans you have?
Well, we're all seeing delays. We're all seeing delays with airplanes, and yes, of course. I mean, it means either you can't grow as quickly as you like, or you have to keep older airplanes flying for longer. So yes, it does have an impact. I think the good news about a Spirit transaction is that is the fastest way to grow JetBlue.
When you look at the macro situation, are you concerned when you see layoffs in companies like tech and corporations cutting back on discretionary spending? You know, airlines have been fairly bullish about the future, but I'm wondering if there's any of those worries playing on your mind now when you look at the rest of the year.
No, it's a good question. Something we think about a lot, and obviously no one wants to see anybody laid off. I think, though, I'd point out that there are many companies still with significant numbers of openings. I know in our own IT team, we had openings, and we're now being able to hire people that was hard to hire before. So not right now. I mean, right now we are still seeing incredible demand for air travel. There's definitely been a shift in people wanting to spend money on experiences, and we're continuing to see that. So right now, no, still very bullish on what we're seeing on demand.
Does that mean that you're hiring some of the laid off tech workers? Is that what you just kind of said?
Well, we're hiring tech workers. I mean, some come from the tech companies, some come from other companies, but yeah, I mean, again, we have a very big modernization program at JetBlue, and we're hiring for sure.
To that point, how long is your visibility in terms of actual demand? Like, it feels okay now. When do you get cloudy?
Yeah, I would say we have good visibility 3 or 4 months out.
Okay.
I think beyond that, I mean, we feel good about the summer, although we don't obviously have much visibility yet. But certainly what we're seeing really through to March or April right now is still incredible strength.
We heard from Airbus earlier in the week having trouble with their production targets for one of their types of jets. I'm wondering, how has Airbus reduced the number of planned JetBlue deliveries from this year? You mentioned 22 in January. Is that going to affect what you're expecting to get from the plane maker?
Yeah, we had reduced deliveries last year and this year. We expect the same next year as well. So we've been planning that. When we gave capacity guidance on our January call, we had factored into that guidance. We've been able to mitigate it somewhat by flying older airplanes for longer, but there's no doubt that we would grow a little bit more if we didn't have these delays.
So I'm going to Paris in the summer for my husband's birthday. Am I going to fly on JetBlue?
Hopefully, yes. Why not?
When am I going to know if I'm going to be flying on JetBlue?
Well, when are you going?
I'm going in July.
Okay, I think you'll be good.
I think it'll be good.
Yeah.
Okay, great. Yeah. Last question here. When you look at expansion, like Paris, for example, what does the European economy look like for you right now? I appreciate that you don't have the bookings to really say, but in terms of, say, London and then Europe, what are you envisioning?
Well, we're expecting a very strong summer. We certainly had a very strong fall with our UK bookings. Again, we're not seeing anything yet to suggest that the slowdown is having an impact. And I think whilst it's easy to remember that in the US, things opened up really sort of more than a year ago domestically, about this time last year, we still had some countries with testing requirements. That was a huge, I mean, who wants to go somewhere, maybe get COVID and then get stuck? So it was a huge deterrent. So there's still this whole tens of millions of people who still haven't taken that international trip. So we're expecting an incredibly strong summer, both out of Europe and out of the US.
Yeah, I'm taking my first one this Sunday.
Love
so
it. There you go.
There we go.
Alex, you are the
I'm the
example.
example.
You are the
I'm
example.
the poster child. All right, Robin, thanks a lot. Wonderful to catch up with you. Robin Hayes, JetBlue CEO, thank you very much. This is Bloomberg.